Fantastic. Here we are, and it is our last Smart Investing Before Christmas with Zach Meir and Clem Chambers. Zach is already on. We are waiting for Clem. But right, today I want to just us to focus on a market prediction, because this is what, always when you come to the end of the year, everybody is thinking, oh, what's happening in 2021, what we should expect next year, and everybody is trying to catch the right train, right? And, who better than Zach with his fantastic gem can, tell us what actually we should be pay attention for 2022.
Well, actually, I have to say that to start off with, the Bank of England interest rate rise was a bit of a surprise to me. I think that was a surprise in the sense that it's madness because it's the wrong time to do it. It's madness because I think even though you have inflation, you might have inflation around, maybe it's profiteering inflation. It's still not a good time to raise interest rates. I don't think actually raising interest rates is ever a good thing. All you do is you destroy the economy, and you're basically shooting yourself in the foot with that strategy. And the reason that we've had 20 years without boom and bust is because we stopped using interest rates to try and control the economy. I think it's just a mistake. Okay. If you're going to do it with anything, you do it with the taxes, or you do it with other means, but not certainly, or policies maybe, certainly not with interest rate rises. But otherwise, I think I've obviously, as a person who's I'm not anti the mainstream media, but I'm not exactly for it either. I think the whole spoof with Omicron was, in a way, worse than anything else we've had since the pandemic started. And you saw both times, well, the first scare, which came, I think it was around Thanksgiving or just after Thanksgiving. It was done to coincide with that time as well. I think it was the Friday after Thanksgiving. And so that was pretty evil. So saying Omicron's there, we're all going to die type of thing. So obviously the market fell 3%. Markets fell that time. It was obvious even at that time that was a spoof. It was fake news. And then the markets recovered again. Then we had another attempt at scaring the market. And now the FTSE, for instance, is at the same price or higher than it was before both those scares. I think that kind of thing is absolutely, it's great if you can see now that any scare on the COVID front is fake news. So that's a great opportunity. That is smart investing, I think. If you can see through news and see who's putting the strings, then that is useful. Might also be the case that if you're into the testing stocks, that we have actually probably peaked in terms of their use and everything like that. I think but one of the things I don't understand is why everybody's madly testing. I suppose you have to test if you go abroad, but otherwise, I don't really see what the point is of doing that, but maybe that's a different view. So on the stock market, at least, buying the dips, I think.
If I can come in just for a quick second, I'm having computer problems. I've got to reset my machine. I'll be back in a minute.
Okay.
No worries.
So Zach, let's come back to rising interest rate, because, that was unexpected. What is going to happen as a consequence, or what you are expecting to happen, so people can look at that in 2022?
Well, I think that what I'm expecting is, let's say there will be inflation, but I think inflation around 5% is actually a good thing. We were complaining for many years from 2000, 2002, the pandemic, that inflation there's not enough inflation. They were trying to get things going with money printing and everything else. And I think the right level for inflation is probably around 5%. The right level for wages growth is probably around that level as well. Just if you have it as a sort of historic average. So I don't think there's anything wrong with that. I think that all that is good for businesses and it's good for people. So there's not a problem there. And I think that there's, they should leave interest rates. Basically, not use interest rates for that. The other thing is, if they did raise interest rates, it would encourage people just to put money in the bank and just live off that. And I have to say that I don't think that would be a great move either. So that would be raising rates would be a mistake all round. That said, even if they raised interest rates, people are so crazy on real estate prices and real estate rather.
That's where I was going to come. It's still going to be good to buy houses.
No, because people, even if you told them that they would die tomorrow, they would still buy real estate. I mean, this kind of mania, it's like a drug, and people will just keep doing it. As soon as they make any extra money, they put it into real estate, and the government is still trying to pump up real estate. It's the government's main instrument of power. It's the property owning democracy. The democracy is the weak part of that, but the property owning democracy, and they can control people by having them in real estate and with mortgages, etc., etc. So I think that that state of affairs is going to continue. That the government does everything it can to get real estate up, and it will continue to do that. It's the strongest policy there is, and I suppose if the Bank of England starts raising rates and it starts hurting the property market, obviously I think the government would step in and start doing things to save people. So I think the real estate for 2022 probably stronger than ever. And the good thing, I think, from what I've read recently is that it's spreading out away from like just it being in London. It's actually becoming much more across the board, up north and in the southwest, etc. So I think that is actually a good thing, that the London property bubble is starting to burst. The most expensive areas, Kensington and Westminster, have actually gone down. And I have to say that if you live in those areas, you can probably work out why they've gone down. That the whole quality of life and everything else in the centre of town, I think, it has become rubbish from the traffic situation and the underground and all those things that we use. The transport is a disaster. And I think that people are right to leave London. So that might be something to look at. There might eventually be some bargains in London compared to the other places, but I think there's a more widespread property price rise. I think could be good. Right, Clem.
Finally, I always get problems.
Fantastic.
That's when we're going live.
Listen, with Zach, we have been talking about Bank of England start rising interest rates. So what that will mean for 2022. And Zach was talking about the housing market and maybe people more willing to keep money in the bank. What's your take on that?
I think that's looking. I think everybody's looking at rising interest rates through an old-fashioned lens, where they were used to control money supply. Now, if you keep printing money, you can have interest rates where you want. I mean, in fact, if you go to Turkey, which has 30% inflation or 25% or whatever it is, they've got interest rates of 17%, and Erdogan's been criticised for bringing them down a couple of percent. So, high interest rates and inflation can go hand in hand, because after all, that's what the 70s were. But the key is so-called liquidity, the availability of money at a price. And in the old days, interest rates would go up and there would be no availability of money. You'd put interest rates up to try to get money to become available. That's why interest rates went up. I'll pay you more if you open your purse and give me some of your money. Oh, no, I don't want to open my purse. Oh, I'll give you even higher interest rates. Oh, okay. That's the old supply and demand method where interest rates are the key. However, when you have a central bank that says, oh, a little bit short of liquidity, give me any old piece of paper you like, and I'll give you a treasury bond, which you can turn into cash, then those rules don't apply. So, everybody's, we have low interest rates now, right? Well, tell that to your credit card company. They're charging you 18%. They don't seem to want to give you low interest rates. So interest rates is what you get offered, and interest rates is what you take when you want money.
Yeah.
Yeah. Now, if you want to buy a house, you could get really low interest rates. And that has fueled the boom in house prices, obviously. If there was a oh yes, you can only borrow half of the value of your house, and by the way, it's only at 2.5 times your salary. Oh, and by the way, it's 11%. Then house prices would be totally different from the way that they are today. However, there's no difficulty getting money in houses. So let's just say they put up interest rates and house prices, got hit by the fact that now your mortgage was that much more expensive, etc. That would have a downward pressure on the whole of the economy, because most people, particularly the old that have not saved, use their house as an ATM, and they remortgage or they downsize. The amount of people I see that have retired at 45 or 50 and then downsize or move into a smaller place or leave the country that they retired to and come back to England for a small place. And they say, oh, well, you've got to go back to a family. Like, that's not, they've run out of money. And therefore they're cashing out their house to actually carry on their retirement. So the house is the asset which people use as an ATM. Now that would obviously have a major...
I like that, Clem. This is brilliant. House as an ATM.
But in America, it's even simpler. You have what's called a credit line against your house. And that's an overdraft facility. It's not even a loan. You just go in and you borrow money off them and they tack it on your mortgage automatically. I don't know whether that's in the UK anymore, but that's what people, the rich do. They have these credit lines based on collateral. So collateral is all important. You have a big lump of collateral. I mean, a Mr. Musk has obviously a trillion gazillion of Tesla shares, and they say, you've got a lot of them. You can have 20% of that in cash whenever you feel like it. Yeah. But that's the top end of the money pyramid. But so if money became tight and if there was a pressure on houses, that would be calamitous. But interest rates can go up. And as long as companies can go, oh, it's 5% now. Oh, okay. Oh, it's 7% now. Oh, okay. Oh, it's 9%. Oh, okay. We'll take that. That everything will be okay because the cash is available. In the old days, interest rates would go up and a company would go, can I borrow money, please, Mr. Bank? And Mr. Bank would go, no. And they go, oh, I'm going to go bust then. And the bank would say, well, I've got your house. You're going to have to pay off your overdraft. Yeah. Because the money dried up. And that's what all these liquidity operations that you've been seeing are about. Industry goes, we need to roll our debt, debt, we need to roll it. We've got some coming up next year. And anybody that's followed companies that have got big debt will know that, in the distance, there's these loans coming due, really, really scary. Maybe they're meant to raise more equity. Well, out comes the bank and says, yeah, well, we'll make sure that there's enough money, that there's so much money out there, they'll be pushing it on the companies to take it. And that is the environment today, because even while they're tapering, they're still pushing new money out. And even when they stop, there'll still be a huge amount of money out there. Now, if for whatever reason it starts to freeze again, all they'll do is they'll push more money out. They'll say, hey, have you got a bond? Yeah, we'll take that. Yeah. Thanks very much for your bond. Here's our treasury bond at a premium to your rubbish, but nowhere near as much of a premium as it should be. And they'll take our wonderful money and go turn that into cash and carry on, employing people. That's what happened in 1923 in the Weimar Republic. The government said, we will monetize corporate debt. Okay, so any company could say, we're making cars, here's our bond, here's the Clem motor vehicle bond, I'll have 10 billion please. And the government said, yeah, sure, I have 10 billion cash. Thank you very much for your bond. We've got that bond. And we'll put that in our bottom drawer and carry on. Yeah, and they just did that willy-nilly on purpose to devalue the mark so they could pay off the Versailles, could say to the Versailles Treaty people, hey, look, we've destroyed our currency. Here's your debt in one large note of worthless paper. And that was their kind of strategy. It didn't work, but that was their strategy. But the mechanism for it was the monetization of corporate debt, which is quite a good idea. Because you could, for example, let's say that UK got into trouble and further down the line. You could say to companies, look, you give us your bond and we'll put that in a pension fund. Okay, and here's cash. Or, by the way, your equity, FTSE 100 companies, if you want some more money, if you want to recapitalize yourself, no problem. Just do a share issue of 10% of your market cap. We'll take it, put it into our pension fund. Here's the cash.
Yeah.
Right? So there's all those ways of tiding companies and economies over in cash, of course, you increase the money supply. And if production doesn't increase, you get inflation.
So basically, you're saying maybe interest rate, they go up, but the money will still be available.
Well, as long as they make the money available by hook or by crook, then nobody's going to go bust. And what happens is, see, back in the credit crunch, GE, all the big companies in America do this really, really terrifying thing. I don't know how they can sleep at night. But if they want to pay their wages on Friday, they don't have the cash in the bank. They write a letter, a contract, and they send it to their bankers and say, give us 200 million tomorrow, we pay the wages. And the banker goes, yes, sure, no problem. And that piece of paper is short-term paper. And then they pay it off out of cash flow in the next few days, and life goes on. But they don't have the cash in the bank. The bank makes the cash available on the basis of a short-term paper. Yeah. Now, in 2008, when the whole market froze, GE went, can we have whatever their wage bill must be, just astronomical. Hey, could we have a lot of cash, please, at our bank? Here's the overnight paper we always give you on a Friday. And the bank went, no, we're going bust, so we don't have the cash. And GE went, government, will you give us the cash for our overnight paper? And the government said, oh, blimey, the market's just going down because GE don't pay wages on Friday. Boy, are we going to have a problem on Monday. So we went, yeah, sure. We will stand behind big companies' overnight paper. The overnight paper market will stand behind that. So GE got its wages. That was the bottom of that crash. And you can see it going, oh my God, the overnight paper market's going to stop. And all the big American companies won't be able to pay their wages on a Friday. Oh, what's going to happen there? And the government bailed them out and they went boing. And that was the end of the bottom of the market crash at that point because of the overnight paper. Now, the fact that GE carried on going for the next 10 years and maybe makes profits, who knows these days, was because that money was available. And if that money hadn't been available, they would have gone bust because they wouldn't have been able to make the payroll. So you can see that availability of money at any price is the key thing, not the actual rate, which any price is. And when your government has established for over the last 10 years, that when the system freezes, because the money's there, it's just not flowing because people are too scared, they're all taking their chips off the table and leaving the casino, right? They come in and they say to everybody, no, go back to the tables, we'll make sure that the money's flowing. We will make that money flow, and therefore the system will not grind to a halt and stop. And that is a big, big difference. And that's kind of disconnects interest rate from what it used to do in the past, when if interest rates up, the market would freeze and companies would go bust, not because they couldn't operate, but because they couldn't roll their debt. And there is not a FTSE 100 company out there that would not go bust if they could not roll their debt. All you've got to do is look at their long-term debt and imagine that they couldn't keep that balance of long-term debt, which has to be tipped over every few months, parts of it anyway. If they couldn't roll that, what would happen to them? They go bust, all of them, every single one of them. So the availability of cash to roll debt is vital, but basically de facto, the governments are guaranteeing that and have guaranteed that since 2008.
Okay. Talking about prices, obviously with the COVID, we have got disruption of supply chain. What will be interesting to understand is, do you think that because of that, some sectors they're going to have prices going up? So for example, like we have seen the second-hand cars prices gone through the roof. So is actually this disruption in the supply chain creating problems?
Well, I see. I don't totally agree with that idea. I think that's a simplification of what's really happened. What has actually happened over the last 2 years is companies have destocked, because they've got warehouses for the parts and components, etc., that may be not on their books. Yeah. And they've got, everybody leave the warehouse, or not the warehouse, but everybody leave the factory floor, leave the offices, work from home and all that. And they've got this asset, which is stock, which may not be valued as particularly high in their books. And they have ran down their stocks to keep the cash flow. Yeah. So now things are ramping up again. They don't have the stock. So it's actually they destock.
Okay.
It's not necessarily the supply chain because the lorry drivers are driving around and the ships can't land. It's because they ran out of stock or they're very, very low on stock. So when you ring up and say, give me a...
Why has nobody said anything like that? I mean, just that's the thing, it's talked about for,
Because everybody's blaming COVID, isn't it?
I mean, no, but it's just...
Well, because I learned that, you've probably seen this yourself, Zach. You go into a TV studio and there's a presenter there. The presenter knows nothing because they can't afford to know anything because all the time they're just reading from the teleprompter, right? And they come to work and they read from the teleprompter and they leave. They're not getting any information in. They're not studying books. They're not reading newspapers. They're not economic experts. They're presenters and they don't know what's going on. So if somebody says it's 10 times less, which is a meaningless phrase, they go, here's 10 times less. They don't go, there's no such thing as 10 times less. Multiplication doesn't make things smaller, 10 times more smaller. How does that work?
Problem across the whole media space. That's why you have now.
Exactly. So you hear people talking about supply chain problems.
Yeah, you have people on Twitter who, in general, if they're, they sort of talk about, they know about, geography or the market or this or that, there's much better information from them than there is from any columnist in a newspaper. I mean, that, then the columnists only write stuff which they think will get read, rather than actually provide any information. So if you say that everything has gone to pot because of the COVID, you get more views. If you say everything's actually okay, then nobody's a bigger article. So
but this is why you get people like Coindex saying that Bitcoin is not a hedge against inflation anymore.
Well, it was yesterday, but it isn't today.
Yeah.
It will be again tomorrow. But, I think destocking has been a very big factor in the supply chain problem. Everyone's thinking it's ships can't get into port and lorries can't get down the road and all that, which is an element of that. But the destocking during the last 2 years is a big issue. So at some point, all these people will restock because the cost of goods of making another widget is practically zero, right? So, but the time it takes is long. So they will restock. And that probably generate large amounts of profits because they're writing in what they're going to sell it for next year. So they will restock, and then that will all that problem will then go away. And
so basically, if you have got second car, better that you sell it now rather than wait for the price to go up.
Well, I mean, isn't the problem with cars the fact that they don't have new ones? This is an example of destocking, isn't it?
Yeah. And
they don't have the chips to put in them because they rationally told the chip makers to stop making them. So they destocked and the chip makers destocked. So it's the destocking and they'll catch up. I mean, the good thing about capitalism is everybody goes like the clackers to make money. So they will be falling over themselves to get the stock there because that's the whole point of capitalism. Wow, the price has gone through the roof. If only I can make more over here and get them to there, I'll make more money. So they will be running pretty hot, I should think, to get those pipes full again of stuff. And then that will all go away. I mean, is there still a lorry driver shortage?
No, I don't know. Maybe a blueberry one.
You're not hearing about it, so it must be good news, right?
Okay, right. Let's go back talking about market prediction. What else we should pay attention for 2022?
Well, I'm going to have a fight with Zach now because I'm going to say
gold. We bring up gold. No,
yes, I think gold. I think the precious metals are looking interesting, and there's a new thing that I find even more interesting. Is that palladium predicts inflation and economic activity, because palladium is all about all this new green stuff and catalysts and clever metals and all that, exotic metals. And so it goes mental. When gold goes up a little bit, palladium just goes up like 7%.
Okay, we like that.
So, but it's a bet on palladium goes up when the economic activity is going to be going up, and palladium goes up when inflation, as a gold inflation heads at the same time. So it's like a double signal. So that's quite interesting. And I think it's looking. I know I'm now a gold bug. I'm ridiculous. Every time I meet and tell anybody, I'm going to say it's going up, even though it hasn't. But I think that's going to be positive.
Okay, Zach. Do you have any palladium company that you have been watching, or you talk to the CEO?
I think there's a new company coming to market. I'm not quite sure what I'm not supposed to say, but there is a palladium play coming to the London market quite soon. Obviously, Eurasia was rather controversial palladium play, and that went up from, I don't know, like half a p to it's now 22, 23p. So it's like a 700 million pound company. That did very well. And I think, to answer Clem's point, even though I don't like gold and I don't like, like trying to say, gold's $1,800, going to go to 22. I think the best way, if you have Clem's mentality, then I'm not sure how many people do have Clem's mentality, but if you have that view, then I think you just try and find the best palladium stock or the best gold stock and do it that way, so that even if gold doesn't go up very much, the stock that you bought into is well geared to the potential of gold going up, or it makes money at 1,200. It mines gold at $600 an ounce, so it doesn't matter whether gold is 1,800 or 2,000. I think with these things, if you find your right gold stock, I'm trying to think of one that I really like.
Sabani Stillwater.
Yeah, exactly. So
that's one of the ones that I hold.
Yeah, exactly. So I would do that. I mean, I think if you do that, then if the company's throwing off cash anyway from its gold mines, then it doesn't really matter whether gold goes up a lot. But obviously, if gold does go up a lot, it's going to make even more money. So you are in a relatively comfortable place. But taking a punt on gold futures or ETFs or whatever else is out there, you could be sitting there for months or years, and it's not going up. So I think gold stocks or palladium stocks are the way to go. And probably, I think anyway, that's a good area to be in. But I think producing ones rather than the hole in the ground that may or may not be full of anything.
I think it's quite interesting. I was thinking last night about gold in general. When you think the major non-governmental use of gold, outside of electronics, of course, is jewellery, and how many people would be going down to down the high street to buy gold rings and necklaces and stuff in the last 2 years? I should think very few. So when you think that one of gold's main usage has actually been on ice for 2 years and it's held up, that's actually quite a positive. And I hadn't really thought about the fact that actually there are uses for gold. And one of them is, very much to do with meeting people and going around and showing off, which is jewelry. And, that's been on ice for 2 years, hasn't it? So when things open up again, if they are to open up again next year, then, there'll be a jewelry demand. Because certainly the coin makers have found it extremely difficult to get hold of bullion. And so that, with the jewelry market kicking in as well, that should be interesting. And that may be one of the reasons that gold has been lackluster.
Clem, a question. Is the gold going to be the most favorable metal for jewelry, or do you see more interest in silver, maybe because of the new generation?
Well, silver's got pop. Yeah, silver's got the most alpha. It pops more. But there is a lot of it, because, if you dig up, if you make apples, there's always a byproduct of silver. Anything you do in mining tends to have a silver output attached to it. So there is a lot of it, but there's 80-to-1 ratio now, which is near historic highs. So if you believe that gold would go up, silver would follow, and probably if you had that boom cycle that we're expecting or hoping for in gold and silver, then silver would go further. But I've got to say, gold is boring.
Okay.
It is really, really boring. If you bought a great stock and you could do 100% on it in a year, easy. But you won't do that on gold. So, for the traders and the speculators, gold is dull, dull, dull. But if you're worried about actually putting a large amount of capital in a safe place away from inflation, it's you don't care whether it's dull. You just don't want to get eaten alive by inflation.
Talking about jewelry, what about diamonds and gemstones? And there are many companies, they have been trying to, bring these, great story, great jewelry, great mines to the stock market.
You know the old story about, if you're playing poker and you can't see the idiot at the table, then the idiot is you. Well, I've been to Antwerp and I bought diamonds, and I'm definitely the idiot at the table there. So it's like, you know, you're dealing with people way too smart and way too good at it, and you really, it's very difficult to buy diamonds and be assured that you're not you know, getting a pup, or when you come to sell, you won't, you know, try to sell to the wrong person. There's that oh dear, you know, diamond people are sharp, super sharp, and that's one of the troubles with collectibles, is that you're not an expert, and you know, you come up against dealers and they're all sharp as razors, and it's hard to have a safe investment when you're surrounded by experts who are ruthless. And you know, I'm sorry, but the diamond and gem business, they are, you know, real players, and you ain't. So it's hard not to come out behind with that sort of business.
Okay, Zach, any other comment on?
I think we got to after weeks of issues, finally in agreement with Clem on the inflation player. So I would probably go for the silver, and that's probably, I agree that I think silver is. I also feel silver's got a bit of, you know, utility, which it's through as well, and obviously it's much cheaper anyway. So I think silver is my version of gold.
We have Hochschild, that was a company that we mentioned a few times. We're still keen on that. They have some exposure to silver.
I'm not sure that ended well, actually, the Hochschild story, but yeah, in general,
I mean, I don't think it's changed much. You see, I've got a portfolio, so I don't really zero in on anything particular. So, you know, my gold positions, I've got about 9 different gold mines, and if one of them falls off its perch, I mean, I would go, what's the, you know, I'm going to buy, let's say, 9 gold mines. I'll buy 3 that are dull as ditch water, which is quite difficult in gold. And then I'll buy 3 which are, you know, a little bit interesting, a little bit spicy. And I'll buy 3 that are insane. Yeah. And then that will be my portfolio of risk.
Okay.
Yeah. And I might buy a lot of the boring, quite a bit of the slightly spicy, and a little bit of the super spicy, and mix and match it. But I'm trying to build a curve of risk. So if the super spicy goes off the dial, that's great. If it disappears, don't care. So, you know, in the middle there somewhere, I mean, there's the big guys like Barrick and Newmont, who are huge and mainly cited in America, etc. And they're the double ones. And then you've got the Sentiments and the Hochschilds, who are in the slightly spicy zone. And then you've got the, what's that one you mentioned yesterday? Resolute. Is it Resolute? Yeah. Resolute, which I would say is pretty spicy, and I hold some of that one because it's pretty spicy. And overall, you've got a exposure to gold risk by doing that, rather than putting it all on one. I'm going to go for the super spicy, and I'm going to make it a lot. Oh, I'm dead now. You can I put it all in the boring one, and if only I'd done that. You get that mix, and that gives you a exposure, and that's what you're looking for: exposure, not chasing and saying, oh, that CEO's bright and that hole's deep and that country is great. Not that sort of picking. You don't want that.
Okay. Zach, anyone in the small cap space that you are?
Yeah, no, interesting, because the 2 that I stuck my neck out was just because of my, you know, because obviously my own area, you know, the tech investment area that I've mentioned a couple of times, my new IPO, Lift Global Ventures. So it just made me look at other tech investing companies on the London market. So I've mentioned Gunsynd, where I think I know the I know the company very well. The guy there, Pete Roos, is I think a brilliant young investor, and that stock, they did very well over the year in terms of, you know, liquidity events and coming up with the goods. And the market got the share price the same as it was this time last year, which seems unfair. The next company, which I think I mentioned, was PIRI, on the basis that it was. Shares were trading at 5p and the NAV was sort of 4.5 or 5p, just about exactly was on NAV. And this week, I think it's up at 7 or 8p or 7.5p. So
yes, it's about after you mentioned it.
Yeah, exactly. So that was very nice. And then I thought, actually, because of that NAV factor, if you look at it, the most interesting one of the lot is still actually in that small, the small end is Seed Innovation. Seed Innovation, which is CBD, cannabis, and gaming, and basically anything new and trendy. They're into that. So Juvenescence is one of their investments that's trying to keep you alive or keep you looking young, like Clem, and that kind of thing. And so Ed McDermott used to be a stockbroker. I knew him when he was a stockbroker, and he went into this area, and he's done really well. Very hardworking. A lot of good work's been done this year over the pandemic. There, the NAV was announced, I think, a couple of weeks ago at 10.98 pence, when the shares were 4.5, 5, and I think they've gone up to 6 now. I interviewed him a couple of weeks ago. That helped, or something helped anyway. But the differential between the NAV and share price, 6p versus nearly 11, suggests that, and the guy knows what he's doing. Suggests that it's a good thing to have a look at. But it is this malaise of, the stock market is a very grumpy, cynical place. And that is something that I'm going to obviously have to address when I'm on the stock market myself, early next year. I think that's something that you've got to communicate, you've got to explain. You can't just sort of allow the thing to explain itself, because I think, Seed has not, Seed has done very well, but people don't get it unless you literally spell it out. So that the NAV is 11, the share price is 5p or 4p. This is a slight disconnect here, that kind of thing. But that's the way the market is at the moment. So Seed Innovation, the code is SEED, not surprisingly, and that.
So anybody that is trying to perhaps rebuild the portfolio, because that's what people do, going in the new year. Maybe let's start with Clem. How would you build, how will you refresh your portfolio going into next year?
Well, one of the ways to refresh your portfolio is to sell everything and then start again. And I do that normally when I go, oh no, something bad's going to happen, and I sell everything. And then I wait until that bad thing has gone away or happened, like the COVID thing, which a certain young lady called Stefania, when she rang up, said, "Mamma mia, they shut Italia. Oh no, my mama's Latina." And I went, "Oh, holy cow, that's not good." And I sold everything. When those things happen, because when you get back in again, you don't necessarily buy what you sold. And some people say, well, look at your portfolio, would you buy it again at this price? And most people would say, well, no, I wouldn't. And then the logical answer is, why are you still holding? And if you take that logic, it's pretty harsh on you. You go, oh, but no, don't sell. Oh no, don't sell, please. But you wouldn't buy it now. Oh, I know. Well, then why are you holding it? My brain hurts. And even for me, I can't do that.
Well, what's the first? If you had no stocks, I mean, you'd obviously did that ahead of March 2020 and that time. If you had no stocks now, you were starting from scratch.
Exactly. What would you get?
I would. To be honest with you,
don't say gold.
The thing that I would look at hardest is gold. Is my gold position, because they haven't behaved as I expected. In fact, they burnt me. Quite, I probably down about 20% on my gold holdings. And I've got to ask myself, why am I still holding it? So you re-examine it and you say, no, I don't understand. But there's so much in the market at the moment that I do not understand. And I don't do that. I don't understand, for example, how M&G, we all know who they are, can have a 4 PE. A 4 PE, right? And
the market
a 9.17% dividend. Yeah, 9% dividend.
Yeah, but that's getting on. That's on my tech investment sort of moaning thing. That literally you've got companies who do everything right. Obviously, M&G is one of those companies, on a large scale. People just obviously do not like investment companies in that way, or they don't want to rate them. They just say, because there's no risk involved, you're making money so easily. There's no excitement there. Whereas they prefer at the moment, they prefer blue. They prefer 80. I think that the shares that have gone up the most this year are 80% blue sky and 20% reality. You can't have the whole sky, but it's that kind of relationship, a ratio, or maybe it's like. I totally agree with you on that point. My strategy, it's long term,
is to buy the companies that the market hates, that are great companies, because in 2 years' time, someone gets a fly up their nose and goes, oh my God, MG, oh, and then the herd jumps in on them and they double. And you go, ha, 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 and you sell.
So
and then it doubles again. But, you know,
yeah, the gut. So the three things that I've talked about recently that I can remember, I can't remember. I mean, maybe I think Tirupati I talked about as well, and that's bounced a bit. But the stuff which is just like, at the moment, they can't get arrested. People don't like them. They're unloved. They're obviously unloved. Therefore, you should take a look at it. So at the moment, there's the one I can think of now, which is in the, we can't, you know, the unloved category, deeply unloved category is United Oil and Gas, producing oil and gas company, mostly in Egypt. It's 2p or 2.1p. It floated 4 years ago at 2.5p, and obviously it's not loved. I mean, it's really not loved at all. So that's the sort of situation. With putting my Clem hat on, I would say, because they're not liked, and whatever the company does or says, that, you know, it's not liked, but there is a business there. It's not it's not something which is just airy fairy. I mean, there's 2,000 barrels a day or whatever it is. I mean, it's a decent. I think it probably is 2,000 barrels a day, and it's produced half its market cap in the last 6 months. So that is something which is a Clem trade, right? I mean, obviously you don't know anything about it.
It is. Well, I mean, the trouble is, I can't bear the thought of paying a 10% spread. So I'm knocked out of all these small caps. And I know if I had 50 grand of that stock, I couldn't sell it. They'd go, market maker go, ha, 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 you want to sell that? Oh, yeah. How about a 40% off? You know, and it's like, so, you know, I want to be able to move in a reasonable size without moving the market. And, you know, like,
yeah, but isn't the perfect
Stanley last year, I couldn't get in. I couldn't get in size. And when I finally got in on size and I had my nice little profit there, I couldn't get out again. You can't get involved in shit. And that's a 300 or 400 million pound company. And then it got taken over. But, you know, so to move in any kind of size, you've got to be up in the 250.
The right size seems to me, I mean, obviously you're in a different league, but like if it was me or, you know, maybe Stefania or whatever, or Stefania's obviously in a different league as well. But for me, like, you know, if it's United Oil and Gas or Seed or one of the stock or Tirupati, I buy my 10 grand's worth and I hope that I'll get a 30, 40, 50% rise over, you know, a few months. I mean, that's
Can you get out at
Exactly.
10 grand size at the bid on that company?
10, I mean, yeah, but the 10K is like that's my league, right? A 10K on something.
Can you get out of United Oil and Gas with the 10K?
Yes. Yeah, I could get out of that. I could obviously get into
at the moment, there's only 75,000 up.
Exactly. I think this is a question.
There's only £1,000 up.
Yeah, that is a question that people don't ask themselves. Yeah, there might be, you know, an interesting stock, but can I actually get out in case things doesn't go the right way?
Or get in. I mean, I wonder if I could buy 10 grand worth of that stock on a broker right now. I mean, I should try, shouldn't I? See if I get a quote.
Well, we are.
But I don't want to ruin the pitch by going now.
I can phone up the CEO and say, look, we've got
exactly. Then it start to be like the CEO selling stock to you, and the price is always like the massive
market trade. Know what I mean? But anyway, something for the big call for next year is this, and I think this is quite interesting. The Omicron, right, is more contagious, but apparently way less serious. Now, if you have different viruses of the same breed, it's the most contagious that takes over. So this one's has taken over. It's taken over.
We're saved.
Well, then that means next year will be it will all start to go back to normality, as long as an even more contagious one that's dangerous pops up.
I think actually we're even better than normality. I think the Omicron's actually killed off the normal flu season, and we're probably better off than we would have been without it. Just for this.
Yeah, but next year the flu will be back. But you know, that's just tough luck for everybody. But the point is, normality may reestablish itself next year. And what does that mean? Well, that means a lot for different stocks, doesn't it? And if we are going back to normality, then obviously, I mean, you then have to call what is the effect of a return to some kind of new normal. And I think that will have impact. I don't dare say what I think, because I could be completely wrong. Because it's like, oh, well, that means airlines will go up. And actually, now that all the airlines are back in business, half of them go bust. And you know, bad things happen. Who knows what it will bring? But I think it is positive. Let me just put it that way.
I would stick. I mean, you're in a responsible position and everything else. I think that it would be a real proper boom, and I think that the last little Omicron scare was the final bear trap ahead of the big boom. I think that's a bear trap effect. Bear trap effect. You just, you get the last of the weak hands thinking, oh my God, Omicron, that's it, it's all over. That day, that Friday, the 20, I don't know what it was, the 26th or 27th of November, was I think the final shakeout. It was a bit like when Pfizer came up with their vaccine, just after, or just, I think it was just when the US election was happening, and they held back on the news of the vaccine until the US voting was over, because otherwise it would have helped the incumbent, i.e. Trump. So that turnaround day was key in November. And you'd see a lot of November tends to be the turnaround month, in the sense that you buy in November. Normally you buy in November and you have a good ride until, like say, if it's a good year, January, February, but you normally get a good couple of months, end of year rally type stuff. That's the best time of the year anyway. And it happens, the second, third week of November. So that day when the FTSE went down to, it was down 3% at the end of November, was the buy point in the market. We're 300 points up from that. And I think the boom will now, I think there will be a boom, just because there's been such a shakeout, and there'll be a squeeze. And I think luckily, the market isn't quite up to how good things look if Omicron is the end of the pandemic.
Well, I hope you're right. I'm very long, and but I would say I'm more positive than negative on it, because ultimately there's all this money out there and it's all there to be used. And I do think what I feel is there's a lot of people rearing to go, and that rearing to go, there's a lot of people that don't want to do another ounce of work, but there's a small group of people, the people that make stuff happen. There's a whole pent up energy in that group.
Yeah. It's that cliche. What doesn't kill you makes you stronger. And we are now much stronger than we were 2 years ago, because we've had to go through all this, all the stuff we've gone through. So I think that's the only thing which would ruin it, which is the wild card, is our central banks raising interest rates, 2-3%, 3%, 5%, or whatever they do, and that could be some sort of central bank madness. But I don't think they can do that. I mean, I think they'll just make lots of positioning, and they'll make a lot of noise and go, oh, it's not our fault. It's from over there. It's a ball coming in. It'll go away, and they have to let inflation run at this level for 3 or 4 years. That's what they wanted. It's taken them 13 years in a pandemic to get inflation up to the level of them and the magnitude that they wanted in 2008 and 2009, and they've finally done it. So they can't pretend now that this is awful, because they've been literally printing themselves to death.
Zach, I think it is the other way around. It's very easy to make inflation. If they say, oh, we don't want deflation, and they've got it, it's because they want deflation and they don't want to say they want it. And then when they want inflation and it's inflating and everyone's saying, oh, no, they say, oh, we're trying to stop it. Oh, we're trying to stop it. It's very easy to get inflation. You print money. They can do it in Venezuela. They can do it in Iran. They can do it in Turkey. They can do it in Zimbabwe, no problem. So why can't they do it here? Because they don't want it. And they can do deflation. If they want deflation, they can have it. You just tighten up the liquidity and you get it, right? And if they've got deflation, it's because they want it. Japanese want deflation because they want to bring their population down from 150 million to about 80, where it was in 1950, when you could actually move around in Japan, because there was some space. And to get that, you have deflation, and everybody inherits. And so they get deflation, and they go, oh, we don't want deflation, we want inflation, really, we do. Oh, look, we got deflation. Oh, we don't understand. Why don't you print money then? Like Zimbabwe, oh, deflation, you can't do anything with it. You know, they can do deflation, they can do inflation, and they can stop both of them pretty easily without, you know, just like that. And you don't have to raise interest rates to do it. Just cut off the supply of money, and you know, they can set their base rate where they like.
Talking about tech, because 2022 and 2021 has been a big year for kind of like tech boom, especially in the US. What is going to happen next year? Do you think tech is going to come off a bit, and maybe, you know, more like we mentioned about gold and other kind of sector are going to be more in fashion?
Well, it's very hard to know when so much at the moment is being run by politicians. I mean, central bankers are politicians, really. If you go back to, say, 2006 and before, what ran economics was markets. Yeah, market theory. Good old monarchists back in the 80s said, markets do this better than government. Let the markets do it. Let the markets decide. Markets will balance and get equilibrium. The markets will do this. And then, bang, after the dot-com crash, the economists got in on the game and started to say, oh, no, you need to do this, you need to do that, you need to do this. So the economists took over and the central bankers took over, and they got it all sussed. Remember in 2006, oh, it's the end of boom and bust, and we know what we're doing, the central bankers are great. So the economists took over. And then, bang, 2008, the politicians took over. Well, every step away from the markets is a step towards the abyss. And when your politicians are actually dictating economic policy, boy, are you in for trouble, as we found out in the 1960s and 1970s. So, you know, anything can happen, but they will try to pin prices, I think, going forward. They will try to pin the market in a range. And they successfully did that in America after the dot-com crash. If you look at the Dow, it stayed in a range for years and years. And I just think they will try to keep, or the central bank will try to keep, the equity markets in a range, and they will basically tap liquidity on and off to keep the S&P 500 in a broad range going sideways. And that's my guess. But we will see, you know, in this market, in all markets, you have to have a theory, you have to keep checking it. And if it sticks to your theory, it's right enough. And if it goes away from your theory, you're obviously wrong. And a bit like gold. But that's what I'm expecting to happen. And right now, gold is just starting to act like I'm expecting it to act. It's just starting to curve up. So we'll see in 3 months' time, if it's not doing what I'm expecting to, I'll get out and I'll say I was wrong. But for now, the jury is out, and only the market will decide. Well, maybe not. Maybe it be Mr. Powell who will decide.
Well, thank you very much. I've got to write my letter to Santa because I'm very excited about.
So what are you doing for Christmas, Zach? Anything?
No, I mean, we'll be here. The family will be here. We'll be. They normally go to Spain, but they'll all be here this time, and we'll be eating away, drinking away, saluting to you and Clem, and trying to think of good ideas for
crypto.
No, exactly. This is what I'm going to say. So if you are all about next week, I think we should just focus on crypto, before the end of the year, but only crypto, no stocks, no shares.
I've got a tip for everybody.
Okay, go on. We like that.
You'll hear much of. Now, there's a stock that's going right into the toilet right now, and it's a great company, and I think they've kind of lost their marbles or will to live or both. And it's going to go down. It is going down, and it's on its way down. Don't catch a falling knife, but watch it, because at some point it's going to base.
Okay.
And when it bases and goes sideways, it will be as cheap as chips. So don't buy it. Watch it. Watch it. And when you think it stopped falling and it's now going sideways, when it's starting to inch up, that'll be the time to buy it. And that company is Johnson Matthey.
Palladium.
People,
platinum, yeah. Okay.
And they just made a series of the most lamentable company statements that basically said, oh, we're useless. We're so useless. Oh, totally useless. Yeah, useless. And that hasn't done great things for their share price. But at some point, they'll be so cheap that somebody will come and buy them, or they'll kick the person that says they use this can't compete.
What kind of returns are you expecting? What kind of
Oh, I mean, normally, if you want a number, 30% return is what you get on a contrarian trade. Now, these days, I hold on, I've got 30% profit, I should sell. Oh, 40%, 45, I've got to sell. that's my weakness. If I get too much profit, I just get out before the fun often starts. But classically, 30% is what you should take on a contrarian trade or investment. But you can let it run. They say let it run, but generally anything over 30 to 40%, I'm getting sweaty, and anything 100%, I'm sat shaking in my chair wanting to sell. So anywhere over 30.
I mean, I just want to share the chart before we leave, because a part of March 2020, we are at the same level now there was in 2022 or so.
You see, I would look at it and say, for the last 10 years, it's been around £30.
Exactly.
Now it's 20. And you see, it's just going down and down and down. And they said, one of our major parts of our strategy as a precious metal expert on things like batteries is to do batteries for the future, batteries are the future of the world and the universe and everywhere. But actually, we've decided that we can't compete. And it's like, oh, really? Well, what if you can't compete? You can't compete, period, right? So what's your point then? And you mean you can't make a factory in China or somewhere out there, and you can't get yourself together to compete with other companies? We're all humans, No, we can't compete. We're not going to do that important thing that's obvious for our business. And I mean, that's just like, you might as well, throw your granny down the stairs. And that's exactly what they've done. But at some point, it was cheap before they did that.
Yeah.
But that will turn around. But I mean, it could be £10. You just have to watch it go down, and then you have to watch it go sideways, and then you have to think about buying.
Okay.
But because that is going to be a situation. It's a developing situation.
Very good.
A developing situation. So what you need to watch to get in when the time is right.
Okay. Fantastic.
Not to be chasing opportunities, but to be waiting for them to occur. Lie in wait. I mean, I bumped into this phrase and I love it, which is, I'm a crocodile investor. I just lie on the mud and I just wait for the ideal opportunity to float past in the river, and then I grab it and eat it, and then I go back to lying on the mud.
I love that, Clem. This is brilliant.
And there's a lot to be said to that.
Yeah, fantastic. Okay, thank you so much for the final tip, and I wish you a fantastic Christmas. Happy Christmas to everybody. And if you are around next week, we can just do a crypto one.
Sounds good. I'll be there.
Okay, bye.
Yeah.
See you
Happy Christmas, Zach. Happy Christmas.
Happy Christmas.
Happy Christmas, viewers. See you soon.